LaRue here with TimeWise Financial. Today I'd like to take a moment to review the markets in 2020 and our outlook for the year ahead in 2021. Despite a global pandemic and most of our world being shut down, stocks had double-digit returns, and bonds ultimately provided the protection investors might have expected in 2020. 2020 saw dramatic market highs and lows. As we look at the bottom row of this chart, we can see how different parts of a diversified portfolio performed in the fourth quarter of 2020 compared to their returns for the entire year of 2020. As you can see, the overall trend for these asset classes was up for the fourth quarter. U.S. equities were up for the third straight quarter. International, developed, and emerging markets also finished the quarter up, due in part by a weaker dollar and increased trade activity. Bond markets were up for the quarter on supportive monetary policy. Global REITs and commodities were even up. The top row of this chart shows the returns for 2020 for the entire year. We had a mix of positive and negative returns within the sectors, which is exactly why we need to diversify. U.S. large cap stocks and small cap stocks were up around 20%, even during a crippling pandemic. The worst performers for the year were global REITs, down 9%. And infrastructure stocks down 7%. So let's talk about bonds for a moment. With bonds generating lower levels of income than what investors have gotten used to over the past several decades, many investors may be wondering if there is still even a benefit to owning them within their portfolios. And I think for investors who are unable to withstand large losses in their portfolios, an allocation to fixed income can help reduce volatility and make portfolio drawdowns less severe. Bonds continue to provide great diversification from stocks and help mitigate the losses associated with an all-stock portfolio. Our outlook going forward for 2021 is that the coronavirus should be largely eliminated in the U.S. within the next 12 months, and we don't anticipate any lasting impact on economic activity, with GDP returning to its pre-virus trend. But the pandemic will leave a legacy in terms of an even higher public debt burden and even lower real interest rates. It is likely that over the next decade, we will see a surprise from inflation. So what opportunities are we currently seeing in the economy as a vaccine is widely available and lockdowns start to be eased? When it comes to stocks, as we try to analyze what types of companies will be favored now that we have a vaccine being distributed, we must determine which sectors have the most room to grow. Last year during the pandemic, tech stocks did very well because companies like Zoom and Skype and Apple and Netflix saw a huge uptick in demand. And these companies allowed people to continue to interact while social distancing. As people start to feel more comfortable getting out, coupled with a lot of pent-up demand, we expect the companies that were hit the hardest to rebound. So, for example, travel and leisure companies. When it comes to bonds, interest rates are at all-time lows, meaning that any bonds that pay a decent interest rate are in high demand. And this high demand for competitive interest rates has made the cost of bonds increase and led some investors to taking on a lot of risk buying bonds from countries or companies with poor balance sheets. And not all bonds are created equal. So So we also need to diversify them. So for example, having bonds that offer protection from inflation and corporate bonds from big companies that may be offering higher interest rates relative to government bonds. And lastly, we expect the value of the dollar to fall a bit. The dollar typically gains during global downturns and declines in the recovery phase. Other countries like the UK and Australia and Canada saw their currencies fall a bit in prior years as America made an effort to produce more goods domestically. These countries' currencies will likely rebound as we come out of the pandemic and a more global approach is taken in terms of trade under the Biden administration. In summary, 2021 will most likely bring more surprises, hopefully good surprises at this point. The pandemic will subside, and as restrictions ease and conditions improve, people will regain their footing and begin spending again. And that's exactly what the market likes to see. Thanks and have a wonderful day.